Hello each and everyone, the one who is watching my video. Welcome to AI Smart Education. So in this lecture we are going to see NTA UGC NET Commerce Paper 2, and in this lecture we are going to discuss 50 most expected MCQ on income tax unit, जो कि बहुत ही important सा unit है under the Commerce Paper 2. Okay, जिससे कि आपको बहुत से जो क्वेश्चन है वो देखने को मिलते हैं from the sections or maybe from the different practical work or maybe on theory. Okay, so to watch this lecture to clear all your doubt about the income tax unit, we are going to discuss each and every MCQ with a complete explanation. So to watch this lecture to clear all your doubt. Okay, before that, if you have not subscribed my channel, then please subscribe my channel so that you will receive my lecture on everyday basis. Okay, an assessee paid penalty of rupees 40,000 paid for a non-compliance of the provision of Custom Act. Such a expenditure shall consider as. For this, the first option is revenue expenditure. Here the revenue expenditure is an amount that expended immediately, thereby being matched with the revenue of the current accounting period. It is the expenses incurred during the normal course of a business of its day-to-day operation. Second option is capital expenditure. Now what is capital expenditure? It is an expenses incurred on the asset to create the future enduring benefit. For example, a business might buy a new asset like a building, machinery or equipment, or it might upgrade the existing facility. So their value as a asset increases. Third option is speculative transaction expenditure. Now, as per the section 43 clause 5 of the Income Tax Act, speculation transaction is a transaction where the contract for the purchase or the sale of any commodity, including the stock and the share, is a periodically or is the ultimately settled otherwise than by the actual delivery or a transfer of commodity or the scrip. For this section is 43 clause 5, okay, for the speculation transaction expenditure. And the last one is disallow under section 37 clause 1. Here the section 37 clause 1 of the Income Tax Act provide for the allowance in the respect of any other item of the expenditure not covered by any of the provision contained in section 30 to 36, and it is limited to the amount actually expended during the previous year. The correct answer for this question is option number D, that is disallowed under section 37 clause 1. The next question is under Income Tax Act 1961, interest on capital received by the partner from the partnership firm is chargeable under the head. For this, the options given are profit and gain of a business or the profession. Second option is income from the other sources. Third option is capital gain. And the last option is none of the above. So here, as per the section 10 clause 2a, please remember the section again, that is 10 clause 2a. Shares of the profit received by the partner from the firm is exempt from the tax in the hands of the partner. This exemption is limited only to the share of a profit and does not apply to the interest on the capital and the remuneration received by the partners for the firm or a LLP. Any interest, salary, bonus, commission or a remuneration by whatever name called due to or received by a partner of a firm from such a firm to be extended under section 40 clause B is taxable under the profit and gain of a business or a profession. We also call as PGB and P. The full form of PGBP is profit and gain of a business or the profession. The correct answer here for this question will be option number A. Under Income Tax Act 1961, interest on the capital received by the partner from the partnership firm is chargeable under the head profit and gain of a business or the profession. Method of accounting is not relevant for the computation of income under which of the following head. In this question, they ask you the method of accounting which is not relevant for the competition and the income under which of the given head. For this, the options given are income under head salary. Second option is income under the head house property. Third option is income under the head capital gain. For this, they given you the code, and from that code you have to select the correct one. Okay. Here the income chargeable under the head profit and gain of a business or a profession or the income from the other sources shall be computed in accordance with either a cash or the merchandise system of the accounting regularly employed by the assessee, where the assessee officer is not satisfied about the correctness or a competenceness of the account of the assessee, or where the method of accounting has not been regularly followed by the assessee, or where the income has not been computed in accordance with the income computation and disclosure statement, that is ICDC, means the income computation and disclosure standard as a notified. The assessee officer may make a best judgment assessment as provided in section 144. Please remember the section, that is 144. In income tax unit, the most important thing is to remember is the sections, because you will receive the question on the sections only. The correct answer for this question will be option number D, that is all of the above. Income under the head salary, income under head house property, and income under head capital gain. In which of the following cases the interest-free loan is not treated as a perquisite? In this question, they ask you given which case the interest-free loan is not treated as a perquisite. Now, what is the meaning of perquisite? The perquisite may be defined as any casual or a benefit attached to the office or a position in addition to the salary or the wages. This perquisite is defined under section 17 clause 2. Please remember the perquisite is defined under the section 17 clause 2 of a Income Tax Act as including clause I, the value of a rent-free concession, rent accommodation provided by the employer. For this, the first option is if the amount of a loan is less than or equal to rupees 20,000. Second is if the loan is given for the medical treatment of a prescribed diseases. Third is both A and B, and last is none of the above. Here the perquisite allow outside India by the government to the citizen of India for rendering the services outside India, that is under section 10 clause 7. Rent-free official residence provided to a judge to a high court or a supreme court for a official of the parliament, union minister or a leader of a opposition in the parliament. No perquisite shall arise if the interest-free concession and loan are made available for a medical treatment of a specific diseases. Rule 3A, where the loan is a petty not existing in the aggregate rupees 20,000. No perquisite shall be arises in relation to the expenses on the telephone, including the mobile phone incurred on behalf of the employee of the employer. The answer here for this question will be option number C, that is both A and B. When a person reduces a total income by making a false claim, it is a process of. Here they are asking you if a person or a assessee is reducing his total income by making a false claim. It is a process of. For this, the options given are tax avoidance. Here the tax avoidance means taking a undue advantage of drafting the mistake for reducing the tax liability and thus avoiding the payment of a tax which is lawfully payable. Second option is tax evasion. It is an illegal activity in which a person or an entity deliberately avoid paying a through tax liability. Those catch evading taxes are generally subject to the criminal charges and substantial penalties. Third option is tax planning. Now, what is a tax planning? Tax planning means reducing the tax liability by taking the advantage of legitimate concession and exemption provided in the tax law. And the third one and the last one is tax management. Here the tax management means planning affair in such a manner so that the tax obligation is managed properly. The objective of a tax management is to comply with the provision of the income tax law and allied rule. Tax management help in avoiding the payment of interest, penalty and precautions. Okay. The correct answer for this question will be option number B. When a person reduces the total income by making a false claim, it is a process of tax evasion. Return on income is submitted under which of the following section? Okay. So here they are asking you when the person or a assessee is making the return on the income, under which section he is submitting that. For this, the options given are section 138. Section 138 of the Income Tax Act 1961 is deal with the mechanism for disclosure of the information in respect of the assessee under the Act. Subsection clause 1 of this section provide the CBDT or a income tax authority specified by it may furnish such a information as obtained in the performance of their function to the authority either dealing with the law related to any tax, duty, cess or a foreign exchange or the authority. Second option given is section 139 clause 1. So here the key subsection of section 139 are section 139 clause 1 is a mandatory or voluntary for the returns. Section 139(3) is for filing the income tax in case of a loss. Section 139 clause 4 late income of return. Section 139 clause 5 is for the reverse return. Okay. And the third option is section 142. Here the section 142 clause 1 of Income Tax Act 1961 is for the empower income tax authority to issue the notice for making the assessment where the return has been filed, or if the return has not been filed, then to furnish the required information in the prescribed manner. And the last option is none. The answer for this question is option number B, that is section 139 clause 1. And the Indian citizen is living in India during the previous year for taking an employment in England. For how many days at least he must stay in India during the previous year in order to be a resident? If suppose I am living in India for any purpose, okay, and to get a resident status in India, how many days I have to stay in India? For this, the options given are 192 days, second is 90 days, third is 180 days, and the last is 150 days. And the individual is said to be a resident in the tax year if he or she is physically present in India for the period of 182 days or more in the tax year. 182 days is a rule, or a physical present in India for the period of 60 days or more during a relevant tax year, and 165 days or more aggregate in the 4 preceding year. In the event of an individual who is a citizen of India or a person the Indian origin leave the India for the employment during and the financial year, he will be qualified as a resident of India only if he stay in India for the 182 days or more. So to get a resident status in India, the person have to stay in India for at least 182 days during the previous year. The next question here is, an individual has lost his both the leg permanently. He is entitled to deduction under section. For this, the section given are ATG. ATG of income tax provide an income tax deduction to the taxpayer on the donation made to the charitable institution and a specified trust, certain fund. This deduction is available to all type of the person. Second option is ATD. And an individual or a HUF can claim the deduction under section ATD for the A medical insurance premium paid for a self-spouse, children or a dependent parent in any mode other than the cash. Third option is ATU. Section ATU provides a tax deduction for an Indian resident who have a 40% disability. Please remember the 40% disability, okay, as specified by the law. There are different criteria and this is a specified set of the procedure for claiming this deduction under section ATU. The taxpayer which have a less than the 80% disability get a deduction of 75,000, okay, less than 80% disability, okay, that person will get the 75,000 of claim, okay, please remember. And the taxpayer which serve the disability which is 80% or more then get the deduction of 1,25,000. Please remember again 1,25,000 if the person is having a disability more than how much percent? That is more than 80%. Okay. The deduction is a fixed amount which is allowed as a deduction from the taxable income. And the last option is ATCCC. Section ATCCC provides a tax deduction on buying a new policy or continuing a policy which pay the pension with a deduction going to rupees 1 lakh per year. Okay. How much is the 1 lakh under ATCCC? On any expenses incurred in buying or maintaining the policy. The answer here for this question is option number C. An individual have a loss as a both the leg permanently, he is entitled to deduction under section ATU. Which of the following amount is not allowed for the deduction from the income from the house property? In this question they ask you given which is the amount which is not allowed for the deduction from the income from the house property. Now what is the income from the house property? That you have to understand first, because the first and the most important step while answering any question is to understand the question properly. Then only you will be able to answer the question. So the annual value of any property comprising a building or a land, apartment thereto, of which assessee is the owner, is chargeable to the tax under the head income from the house property. For this, the first option is interest on a loan borrowed for the construction of the house property. Second one is interest on the fresh loan taken to the repay original loan. Third option is interest on unpaid interest. And the last option is interest on unpaid purchase price. Section 24B, please remember the section, that is 24B of the Income Tax Act allows the deduction of the interest on the home loan from the taxable income. Such a deduction is allowed on the accrual basis, not on the paid basis. Interest include a service fee, brokerage, commission, prepayment charges. Interest or a penalty on unpaid interest shall not be allowed as a deduction. That means the correct answer for this question will be option number C. That is, interest on unpaid interest is not allowed for the deduction from the income from the house property. So during my previous lecture, I asked you one question and the question was, what are the exemption limit in a hostel expenditure allowance? For this, the options given were 200 per month, 300 per month, 400 per month and 500 per month. Any allowance granted to an employee to meet the hostel expenditure of his child will be completely exempted from the income tax up to the 300 per month. Okay. Up to the maximum 2 child. Okay. If the person is having a 4 child, then he will not get the tax benefit for the all the 4 child, but only for the 2 child. Okay. The answer for this question will be option number B. Okay, here is the last question for today's lecture which you have to answer. The question is GST is, and the options given are central tax, federal tax, state tax and local tax. Please write your answer in the comment box. I am waiting for your answer. Till then, keep watching, keep learning. What is the maximum amount for a deduction from the family pension? In this question, they ask you about the maximum amount which is available for the deduction from the family pension. Here the family pension received by the dependents of the employee is a taxable under the head income from other source. Okay, please remember this. It is a taxable under income from the other source. The TDS is not deductible on the family pension received by the dependents of the employee as it is not covered under section 192 of the Income Tax Act and instead been covered as an income from the other source. Please remember the section, that is 192. The options given are: option first is 20,000, second option is 15,000, third option is 25,000 and last option is none of the above. As against this, one third of family pension or a 15,000, whichever is lower, is allowed as a deduction from the family pension. Please remember, one third or a 15,000. Okay, whichever is a lower. The income such as the LIC commission and the annuity or a bank interest is a taxable under the head income from the other sources. The correct answer for this question will be option number B, that is 15,000. The aggregate value of monetary gift received during the previous year is exempted if it, here they are asking you about the monetary gift which we receive, okay, during the previous year is exempted if it, and the options given are: first option is does not exist 50,000, second option is exist 50,000, third option is exist 45,000 and the last option is none of the above. If the gift received during the previous year is exist the 50,000, then the whole amount of a gift received will be chargeable to the tax. The marriage of an individual is the only occasion when the monetary gift received by him will not be charged to the tax. The gift received on the occasion of a marriage of an individual is not charged to the tax. Apart from the marriage, there is no other occasion when the monetary gift received by the individual is not charged to the tax. Okay, if you are getting married and if you are getting so many gifts, that gift will not further, on that gift there will be a no tax because you are receiving the gift on your marriage occasion. Okay. The aggregate value of monetary gift received during the previous year is exempted if it does not exist the 50,000. Means up to the 50,000 there will be a no tax on the gift. Okay. Once it exists the 50,000 you have to pay tax. Okay. Only the on the marriage if you are receiving any gift then there will be a no tax. Whether it exists the 50,000 or it not exists the 50,000. Income from the other sources may include, here they ask you about the income from the other sources head, which is a one of the head under the income statement. Okay, for which the first option is Indian company dividend, second option is dividend from the units, third option is foreign company dividend and the last option is all of the above. We will see the option, but first you have to understand the question. Once you understand the question, then only go to the options. Because understanding question is the most important part during your exam point of view. Okay. So, what is the meaning of income from the other sources? So, income from the other sources is a one of the head of a income chargeable to the tax under the Income Tax Act 1961. Okay. Any income that is not covered in the other four heads of a income is a taxable under the income from the other source. Because of this, it is known as residential head of the income. The first option is Indian company dividend. A non-resident person generally holds a share of an Indian company as an investment, and therefore any income derived by way of the dividend is a taxable under the head other sources, except where such an income is attributed to the permanent establishment of such a non-resident in the India. Second option is dividend from the unit. Dividend other than the chargeable to the tax under section 115 BBDA received from the domestic company shall be exempt. No deduction of any expenses shall be allowed for such a dividend. Dividend from the foreign company or a deemed dividend mentioned under section 2 clause 22 clause E shall however be taxable under the head income from the other source. Third option is foreign company dividend. Dividend are a charge to the tax under the head income from the other source, and hence the dividend received from the foreign company is a charge to the tax under the head income from the other sources. The correct answer for this question will be option number D, that is all of the above. Income from the other sources may include Indian company dividend, dividend from the units, and also the foreign company dividend. The next question is, if I win from the cross puzzles, horse race, cards games and a lottery, then the rate of TDS. Here in this question, they ask you if you won from the cross puzzles, any horse race, cards game or a lottery, then the rate of TDS. Now first understand what is the meaning of the TDS. TDS means tax deduction at source. This is the full form of the TDS. It means of collecting the tax on the income, dividend or a asset sale by requiring a payer to deduct the tax due before paying the balance to the payee. For this, the first option is 25%, second option is 15%, third option is 30%, and last option is none of the above. Any income from the winning from the lottery, cross puzzles, cards game and other game, any sort race including the horse race is a chargeable to the Income Tax Act under section 115 BB. Okay, please remember the section. You might receive the question on the section. This section imposes the income tax at a flat rate of 30%. The provision of TDS is applicable on it. Section 194B and 194BB deal with the TDS on such a income. As per the explanation, the correct answer for this question will be option number C, that is 30%. Gift received from my wife is, and the options given are exempted. Exempted means where you don't have to pay any tax. Second option is partly taxable, means there will be a limit. Up to that limit you don't have to pay any tax. Beyond that limit you have to pay the tax. That is a partly taxable. Third option is taxable, where whatever you are receiving will be a taxable. And the last option is all of the above. Here the gift received from the relative, as per the Income Tax Act, the sum of the money received from any of your relative are fully exempt from the tax. Okay, please understand this. The relative term defined by the Income Tax Act, where the spouse of individual will be included, brother or a sister of the individual will be included, brother or a sister of a spouse of an individual will be also included. Okay. So whatever amount you are receiving, whatever gift you are receiving from the relative will be not taxable under the Income Tax Act. The correct answer here is option number A. The gift received from the wife is exempted because she is the relative of that particular individual. Okay. The next question here is income from the other sources is under section. Here they ask you about the section of income from the other sources. The options given are section 56, second option is section 57, third option is section 58 and last option is none of the above. The section 58, section 14 to 59 of Income Tax Act 1961 deal with the provision related to the computation of total income, and section 58 of Income Tax Act 1961 to 2020 provide the amount not deductible. Section 57 of Income Tax Act 1961 to 2020 provide for the deduction, and if we talk about the section 56, then income from the other sources. Section 56 clause 1 of Indian Tax Act, income from the very kind which is not excluded from the total income under this act shall be chargeable to the Income Tax Act under the head income from the other source. If it is not chargeable to the income tax under any of the head specified in the section 14, the item A to E, section 56 clause 2 of Income Tax Act 1961. Okay. The correct answer here is option number A, income from the other sources under section 56. The next question is interest on the saving bank account is exempted up to. In this question, they ask you about the interest on the saving bank account, exemption of that, and the options given are 15,000, second option is 20,000, third option is 10,000, and the last option is none of the above. The interest earned on the saving account is exempted from the TDS under section 194A. 194A of the Income Tax Act, that is, no TDS is deducted on the interest from the saving account. Under section 80TTA of Income Tax Act, from all the saving bank account, interest up to rupees 10,000 earned is exempt from the tax. This is applicable for all the saving account with the bank, cooperative bank or a post offices. If the interest earned from the sources exceeds rupees 10,000, the additional amount will be taxable. Please remember the section, that is 80TTA. Interest on the saving bank account is exempted up to the 10,000. The next question here is the amount of a dividend received from cooperative society is, and the options given are partly taxable where the up to the certain limit there will be a no tax. Once that limit is crossed, you have to pay the tax. Second one is exempted, whatever amount you are receiving will not be taxable, that is called the exempted. Third option is taxable, whatever amount you are receiving you have to pay tax on that, and the last option is all of the above. The dividend from the cooperative society, the income tax shall not be payable by an assessee who is a member of cooperative society in respect of any dividend received by him from the society, as amended by Finance Act 1964. If you are a member of that cooperative society, then you don't have to pay any tax. Okay, so answer here for this question will be exempted. While making a payment of a winning from the horse race, the tax will be deducted at a source if the payment exists, and the options given are 5,000, second option is 10,000, third option is 25,000, and the last option is 50,000. Any income from the winning from the lottery, cross puzzles and a card game and other game race including the horse race is chargeable to the income tax under section 115 BB. The income from the horse racing is taxable, and if the winning amount from the horse racing exceeds the Indian rupee 10,000, the winner will receive the winning amount after the TDS deduction. So the answer here for this question will be option number B, that is 10,000. The highest administrative authority of income tax in India. Here they ask you about the highest administrative authority for the income tax in our country, means in India. The first option is Finance Minister. Finance Minister is an executive or a cabinet position in a charge of one or a more of a government finance, economic policy and financial regulation. Second option is CBDT. The full form of CBDT is Central Board of Direct Taxes, is the authority vested with the responsibility of the administration of the law related to the direct tax through the Department of Income Tax. In India, necessary input for the policy and the planning is provided by CBDT. Third option is President of the India. The President of the Republic of India is the head of state of Republic of the India. The President is the nominal head of executive as well as the Commander-in-Chief of Indian Armed Force. And the last option is Director of Income Tax. Section 2 Clause 34C, the Principal Director of Income Tax as per the Section 2 Clause 34C of Income Tax Act 1961, unless the context otherwise required, the term Principal Director of Income Tax means the person appointed to be a Principal Director of Income Tax under subsection clause 1 of section 117. Okay. The Government of India has considered the number of authority to execute the Income Tax Act and to control the Income Tax Department specifically. The Central Board of Direct Taxes is the supreme body in the direct tax setup. That means the correct answer here for this question will be option number B. The highest administrative authority for income tax in the India is Central Board of Direct Taxes, that is CBDT. During my previous lecture, I asked you one question and the question was, short-term capital gain is a tax at which rate or a which price? The tax rate applicable to those short-term gain is a term as the short-term capital gain tax. The rate of a tax applicable to the short-term capital gain and the short-term holding period differ depending upon the types of the assets. Okay. For this, the options given were normal tax rates, second was fixed tax rates, third was market rates, and last is all of the above. The correct answer for this question is option number A. That is, short-term capital gain is taxed at the normal tax rate. Okay. This is the last question for the today's lecture which you have to answer. The question is, what are the exemption limit in the hostel expenditure allowance? For this, the options given are rupees 200 PM means the per month. Second option is rupees 300 per month. Third option is rupees 400 per month, and the last option is rupees 500 per month. Please answer this question. Write your answer in the comment box. I am waiting for your answer. Till then, keep watching, keep learning. Charter accountant is, whether it is a profession, whether it is a business or a occasion, that here they ask you. Okay. Here the charter accountant, that is a CA, is an international accounting designation granted to the accounting professional in many countries around the world aside from the United States. In the United States, the equivalent to the CA designation is a certified public accountant, that is CPA. Okay. For this, the first option is profession, second option is vocation, third option is business, and last option is none of the above. Charter accountant is a profession. So the answer for this question will be option number A. Set of laws under the same head of a income comes under the section. For this, the options given are section 60, second option is section 70, third option is section 80, and last option is none of the above. So here the each option given is important because most of the time under the income tax unit you will receive the question on the section. So you have to understand each section properly. So what section 60 says? Section 60 and 61 contain the provision when the income from an asset is a transfer without transferring the asset or transferring an asset but the transfer is a revocable. In both the situation, income from the asset is treated as a transferor. Second option is section 70. Section 70 of Income Tax Act 1961 to 2020 provide for the set of loss from one source against the income from the another source under the same head of the income. Then is section 80. Here the section 80C is one of the most popular and a favorite sections among the taxpayer as it allows to reduce the taxable income by making a tax saving investment or incurring the eligible expenses. It allows the maximum deduction of rupees 1.5 lakh every year for the taxpayer total income. The benefit of this deduction can be availed by the individual and a HUF. If you know or somebody from you, if you work under the CA or a tax consultant, that time you will get the idea that 80C section we are using for the tax saving. Okay. Set of loss under the same head of a income comes under section 70. That means the answer here will be option number B. Expenses allowed as a deduction under section which under the head profit and gain of a business and a profession. The profit and the gain of a business and a profession is given under section 28. Okay, please remember here this is given under section 28. But in this question they ask you about the expenses which are allowed as a deduction. Okay, so for this the option first is section 20 to 25. Second one is section 15 to 27. Third one is section 30 to 37. And last one is none of the above. From 30 to 37, there are so many things which are included for the deduction under the profit and gain of a business and a profession. Section 30, what section 30 says, then there will be a rent, rates, taxes, repair and insurance for a building. Then section 31 is there which says the repair and insurance of the machinery. Then is the depreciation under section 32. Then is investment allowance in the notified background area in the Andhra Pradesh, Bihar, Telangana or a West Bengal, that is under section 32 AD. So like this there are 37 different section which you have to read before going to the exam, because this section are very important from the exam point of view. The answer for this question will be option number C. The next question here is long-term capital gain can be carried forward. Here what is the meaning of long-term capital gain, that you have to understand first, because to answer any question you have to understand the question first. So here the long-term capital gain means the investment that provide the return in the period range from the 1 year to the 3 year. If a person hold an investment for the 3 year, the profit is capital gain on the long-term capital asset. The first option is 8 subsequent assessment year. Second one is indefinitely. Third option is 6 years. And last option is none of the above. In case where the entire long-term capital loss cannot be set off against the gain, it is a carry forward for the next year. The long-term capital loss can be carried forward for the 8 subsequent assessment years. That means the answer here for this question will be option number A. That is long-term capital gain can be carried forward for the 8 subsequent assessment years. Speculative business are. Here they ask you about a speculative business. Now before answering this question you have to understand what is a speculative business. A transaction of a purchase or a sale of a commodity including the stock and the shares settle otherwise than the actual delivery or a transfer of a commodity to skip the speculative transaction. The business which consists of a speculative transaction is called a speculative business. As per the section 43(5) of Income Tax Act 1961, the intraday trading shall be considered as a speculation business transaction, and the income therefore will be either the speculation gain or a speculation loss. The income from the speculation gain is a tax at a normal rate. For this, the options given are partly taxable. The allowance which are partially taxable from the tax has a certain limit are called a partially taxable allowance as per the section specified under the Income Tax Act 1961. Then is fully taxable. Here the what is meaning of fully taxable? Fully taxable means whatever amount, whatever cash you are receiving will be taxable under the Income Tax Act 1961. Then is exempted. Whatever amount you are receiving will be exempt. There will be a no tax under the Income Tax Act. This is the meaning of the exempted. For the agriculture income, there is the income whatever we receive from the agriculture is a fully exempted under the Income Tax Act. Here the example of the exempted tax. Okay, and the last option is none of the above. Speculative business are fully taxable. Okay, so answer is option number B. Indexation will be allowed in case of. Here they ask you about the indexation. Under indexation, you are allowed by a law to inflate the purchase price of your asset by the government, notify inflation factor. This factor is called cost inflation index, for which the word indexation has been derived. Okay. The first option is LTGC. Now what is LTGC? That is long-term capital gain. Here the long-term capital gain under the Income Tax Act means the profit earned by the individual on the sale of his investment in the assets such as a stock, real estate, bond, commodities. Basically, it is a gain made on the capital investment. Second one is STCG. Here the short-term capital gain. Short-term capital gain is a tax levied on the profit generated from the sale on the asset which is held by the government, defined the short period, is called a short-term capital gain. Third option is both, that is long-term capital gain and short-term capital gain, and last one is none of this. The correct answer for this question will be option number A. Indexation will be allowed in case of long-term capital gain. How many types of capital gain are there? Here they ask you about the types of capital gain. So there are two types of a capital gain, that is short-term capital gain and a long-term capital gain. The long-term capital gain means the profit earned by the individual on the sale of the investment in the asset such as the real estate, bond, commodity. Basically it gain made on the capital investment for a long time. And second one is short-term capital gain. Short-term capital gain is a tax levied on the profit generated from the sale of the asset which is held for the government, defined for the shorter period. That is a short-term capital gain. The options given are 3, 2, 4 and none of the above. The answer here for this question will be option number B, that is 2. Treatment of loss after the succession come under, and the options given are section 78 clause 2, second option is section 77 clause 2, third option is section 76 clause 2, and the last option is none of the above. Section 78 of Income Tax Act set off of loss in case of a exchange in the consideration of the firm or a succession amended or updated noted on the section 78 of the Income Tax Act 1961 as amended by the Finance Act 2020 and the Income Tax Rule 1962. That means the answer here for this question will be option number A, that is section 78 clause 2. Long-term capital gain is a tax. In this question they ask you how much percentage is allowed for a long-term capital gain. For this the options given are 30%, then is 25%, then is 20% and none of the above. Now at present you must know what is a long-term capital gain because I have explained you in my previous question, right? So here the tax on the long-term capital gain is usually calculated at the 20% plus the surcharge plus the cess as a applicable. Okay. The answer here for this question will be option number C, that is 20%. The next question here is unobserved depreciation can be carried forward for a period of. Here the unobserved depreciation is that amount of unutilized depreciation which is a assessee will not able to claim as a expense due to the lack of sufficient profit in the profit and loss account. Such an unobserved depreciation can be set off against the any head of the income and remaining balance can be carried forward for any number of the period. For this the options given are 8 year, second option is 4 year, third option is indefinite and the last option is none of the above. The unobserved depreciation can be carried forward for a indefinitely period. The condition of a 4-year or a 8-year are not applicable in case of a unobserved depreciation. Depreciation shall be carried forward even if the business or a profession has been discontinued. Order of a setup for the purpose of ITR. The answer here for this question will be option number C, that is indefinite. Set of loss against income under other head of a income under section. For this the options given is section 51. Now here the section 51 of Income Tax Act 1961 provide that any advance forfeitable by the seller of the property is deductible from the cost of asset. Second option is section 61. Section 61 is divided into the three subsections. The proper officer may scrutinize the return and related particular furnished by the registered person to verify the correctness of the return and inform him of the discrepancy notice if any. In such a manner, such may be prescribed and seek his explanation thereto. Third option is section 71. Interhead adjustment, that is section 71, it means a loss under the one head of a income can be set off against the income from the other head of the income but in the same previous year. And last option is none of the above. The correct answer here will be option number C, that is section 71. Business has been defined. In this question they ask you about the business. Here the business simply means any economic activity carried out for a earning profit. Okay. Under section 2 clause 3 has been defined the term as any trade, commerce, manufacturing activity or any adventure or a concern in the nature of the trade, commerce and a manufacture. The first option here is under section 2 clause 13. Here the section 2 clause 13 Income Tax Act says that the business as per the 2 clause 13 of the Income Tax Act 1961, unless the context otherwise required, the term business include any trade, commerce or a manufacturer or any advantage or a concern in the nature of the trade, commerce or the manufacture. It may be noted that income from the business is chargeable to the income tax. Second option is under section 13 clause 2. Section 13 clause 2 of Income Tax Act, if any part of a income or a property of the trust or a institution is or are continue to be laid down to any person referred to as a subsection clause 3 of any period during the previous year without either adequate security or a adequate interest for both. Third option is under section 10 clause 2. Section 10 clause 2 provide for the exemption of an income received by the taxpayer in his capacity as a person of HUF. Now here HUF means Hindu undivided family. Hence any income received by the individual as a member of HUF is exempt from the tax. And the last option is none of the above. Okay. The correct answer for this question will be option number A. business has been defined under section 2 clause 13. The next question is, loss from the house property can be set off against. Here they ask you about the loss from the house property. For this, the first option is business profession. Here the meaning of business profession means to earn the profit by supplying the goods and the services, whereas the profession is an advance or a services rendered by one or a group of a person does not include the manufacturing or a selling of good. Second option is capital gain. Capital gain is an economic concept defined as a profit earned on the sale of an asset which has increased its value over a holding period. An asset may include tangible property, a car, a business, or an intangible property such as shares. Third is salaries. A salary is a form of periodic payment from the employer to an employee, which may be specified in an employment contract. It is constructed with the piece wages, where each job, hour, or other unit is paid separately rather than on the periodic basis. And last option is all of the above. The loss from the house property is allowed to be set off against any other income arising during the same year. Therefore, if there is a loss under the head house property, or there is an income under any head of other 5 head of income, that is salary, house property, business or a profession, capital gain, and other source, these losses from the house property can be adjusted against such an income. So the answer here for this question will be option number D, that is all of the above. Depreciation comes under section which? Under the head of business profession. Here they ask you about the depreciation, under which section it came. Okay. For this, the options given is section 32. As per the section 32 of Income Tax Act 1961, depreciation is allowed on the tangible asset and the intangible asset. Now here the tangible asset means which we can touch and which we can see, and intangible asset are those assets which we cannot see. Okay, wholly or partly by the assessee and the use for the purpose of a business or the profession. Then is section 42. Here the section 42 under the Income Tax Act 1995, special provision for the deduction in case of a business for a prospecting for a mineral oil for the purpose of a computing of a profit and a gain of any business consulting of a prospecting from the extraction or a production of a mineral oil in the relation which the central government has entered. Then is section 22. Section 22 is for the income from the house property. The annual value of a property consisting of any building or a land appropriate thereto, of which the assessee is the owner other than such a portion of such a property as he may occupy for the purpose of any business or the profession carried on by him, profit by which are chargeable to the income tax shall be charged to the income tax under the head income from the house property, and the last option is none of the above. So as per the explanation, the answer for this question will be option number A. Depreciation comes under section 32 under the head of a business profession. Loss from the specific business can be set off. For this, the first option is income other than the salary. Section 192 clause 2B of the Income Tax Act follow an employees to furnish the particular of a income under any head other than the salary for the same financial year and any tax deducted at the source thereon. Second option is any head of the income. So there are 5 head under the income. So first one is income under the head salary. Second one will be income from the house property. Third one will be profit and gain of business or the profession. Fourth one will be capital gain, and last one will be income from the house property. Okay. Third option is profit of any other specified business only, and the last option is none of the above. Loss for the specified business will be set off against the profit of specified businesses, but the losses from any other business or the profession can be set off against the profit from the specified business. After the intra-head adjustment, the taxpayer can set off remaining losses against the income from the other heads. That means the answer here for this question will be option number C. That is profit of any other specified business only. Compulsory filing of loss return has been defined under section. Here they ask you about a compulsory filing of loss return which is given under section. For this the options given are section 80. The section 80C is one of the most popular and a favorite section among the taxpayer because it allows the taxpayer to reduce the taxable income by making a tax saving investment. Second option is section 70. Here the section 70 of Income Tax Act set off loss from the source against the income from the other sources under the same head of income. Third is section 60. Under the provision of section 60 to 64 of Income Tax Act 1961, income although occurring to the other person but the prevent the tax evasion are included in the total income of the individual assessee. Transfer of a income where there are no transfer of the asset. And the last option is none of the above. The correct answer here is option number A. Compulsory filing of loss return has been defined under section 80. Carry forward and setup of capital loss comes under section. First option is section 74 clause 1 and clause 2. Second option is section 73 clause 1 and clause 2. Third option is section 71 clause 1 and clause 2, and the last option is none of the above. Here the section 74 of Income Tax Act 1961 to 2017 provide for the losses under the head capital gain. The improper as such a losses related to the short-term capital asset, it shall be set up against the income if any. Second one is section 73 of the Income Tax Act 1961 deal with the carry forward and set up losses from the speculation business. Then is section 71 of the Income Tax Act 1961 to 2020 provide for the set up loss from the one head against the income from the another. Carry forward and set off capital loss under the head capital gain section 74 if the net result of the computation under the head capital gain is a loss, the whole of a loss shall be carried forward to the assessment year as follows. The long-term capital loss can be set off only against the long-term capital gain. Exemption under section 54 is available to which person? Okay. So here under section 54 of Income Tax Act, an individual or a HUF, HUF means Hindu Undivided Family, selling a residential property can avail the tax exemption from the capital gain if the capital gain are invested in the purchase or a construction of the residential property. Taxpayers such as a partnership firm, LLP companies or any other association or a body cannot claim the tax exemption under section 54. The first option is company, second option is individual or a HUF, and third option is AOP or a BOI. The Income Tax Act 1961 define the AOP. AOP means the Association of the Person. This is the full form of the AOP, and BOI means the body of individual. Okay. Association of a person as an integration of a person or a mutual benefit or a common purpose. This may be individual or an artificial person such as a LLP or the company. Body of individual is similar to the association of a person and is also in the accumulation of the individual who have come together with an objective of earning some income. And the last option is none of the above. Here the correct answer for this question is option number B. Exemption under section 54 is available to the individual and the HUF. Losses of discontinued business of an industrial undertaking after the re-establishment or a renewal can be carried forward up to. For this, the options given are: first is 4 subsequent years assessment year, second one is 8 subsequent year assessment year, third one is indefinite subsequent year assessment year, and the last option is none of the above. Now here the business losses can be carried forward and set off in the subsequent years even if the business has been discontinued. The loss from the specified business that are allowed to investment link the deduction under section 35 AD of the Income Tax Act can be set off against the gain from only the specified businesses. The correct answer here is option number B, that is 8 subsequent year assessment years. What is the charging section of the income under the head capital gain is? Okay. For this, the options given are section 45 clause 2. Second one is section 35. Section 35 with the view to encourage the investment in the scientific research in the country. Section 35 as a interest with the provide for a tax benefit on the expenditure to the scientific research. Section 45 clause 2 of the Income Tax Act 1961 provide that when the capital asset is converted into the stock in a trade by the assessee, the profit and the gain arising on such a conversion shall be charged to the tax as a capital gain in the year in which such a stock in the trade is sold or otherwise transferred. Third option is section 25. Section 25 of a IT Act, that means the Income Tax Act 1961 to 2020, provide for the amount not deductible for income from the house property. And last option is none of the above. The correct answer here is option number A, that is section 45 clause 2. Section 45 of Income Tax Act 1961 is a charging section to the income chargeable under the head income gain in the ordinary course as a transaction is subject to the capital gain in the year of a transfer of the capital asset. When a person reduces a total income by making the false claim, it is a process of, for this the first option is tax avoidance. Now what is a tax avoidance? Tax avoidance means taking undue advantage of drafting mistake for reducing the tax liability and thus avoiding the payment of a tax which is lawfully payable. Second option is tax evasion. Tax evasion is an illegal activity which a person or an entity deliberately avoid paying the true tax liability. Those catch avoiding the tax are generally subject to the criminal charges and substantial penalties. Third option is tax planning. Here the tax planning means reducing the tax liability by taking advantage of the legitimate concession or exemption provided in the tax law. And the last one is tax management. Tax management means a planning affair in such a manner so that the tax obligation is managed properly. The objective of a tax management is to comply with the provision of an income tax law and allied rule. Tax management help in avoiding the payment of interest, penalty and precautions, etc. That means the correct answer here will be option number B. That is, when a person reduces a total income by making a false claim, it is process of tax evasion. Agriculture income is exempted from the income tax under the following section of Income Tax Act 1961. Here they ask you about the agriculture income and its exemption. Okay. So, now what is agriculture income? The revenue from a land in India used for the agriculture purpose. Income derived from the land in India which is used for the agriculture purpose or by an agriculture operation. Okay. Okay, renting or leasing from a building to cultivator or a farmer as a residential place. Now, what is a non-agriculture income? That will be capital gain arising from the transfer of a agriculture land, income from poultry farming, dairy farming, dividend paid by a company out of its agriculture income. This will be not considered as a agriculture income. Now for this, the first option is section 2 clause 1a. Now what is all about? The agriculture income is defined under section 2 clause 1a of the Income Tax Act as per the section 2 clause a1. Okay. Second one is section 10 clause 1. This is given for the exemption under the agriculture income. Third one is section 10 clause 2. Section 10 clause 2 is provided for the exemption of income received by the taxpayer in his or her capacity as a member of HUF. Please remember this. This is for the HUF. HUF means Hindu Undivided Family. Okay. And the last option is section 10 clause 4, certain interests to non-resident. The correct answer here will be option number B. Section 10 clause 1. Which of the following are true in the tax planning? In this question they ask you given which is the true in case of the tax planning. To answer this question, first of all you have to know what is a tax planning. Tax planning can be defined as an arrangement of one's financial and the economic affair by taking a complete legitimate benefit of all the deduction, exemption, allowance and the rebate so that tax liability reduced to the minimum. For this the options given are, it is a futuristic in its approach. Second one is it has limited scope compared to the tax management. Third is the benefit arising from it are limited particularly in the short run. And the last is its main objective is to reduce the tax liability. For this question they given you the code and from this code you have to select the correct one. It is a futuristic in its approach and its main objective is to reduce the tax liability. That means the correct answer for this question will be option number C, that is 1 and 4. The next question here is under section 54 EC, capital gain on the transfer of a land or a building or a both are exempted if the investment in a bond issued by the NHAL. Now here the NHAL means non-convertible redeemable bond with the benefit under section 54 EC of Income Tax Act 1961 and RECL or other notified bond. Here the section 54 EC exemption under section 54 EC is available only towards the capital gain arising on the account of transfer of long-term capital asset. The amount should be invested within the period of 6 months from the date of transfer. Okay. The investment in the long term specify the asset by assessee during the financial year cannot be exceed the Indian rupees 50 lakh. For this the options given are, first option is within the period of 6 months from the end of relevant previous year. Second option is within the period of 6 months after the date of such a transfer. Third option is within the period of 6 months from the end of a previous year or due date for a filing return of income under section 139 clause 1, whichever is earlier. And the last option is at any time before the end of a relevant previous year. As per the explanation, the correct answer for this question will be option number B, that is within the period of 6 months after the date of such a transfer. The next question here is Mr. Arvind incurred a short-term capital loss of 10,000 on the sale of share through the National Stock Exchange. Such a loss is called. Here they given name of the person who lost the 10,000 short-term capital loss of 10,000 on the sale of the share through the National Stock Exchange, and such a loss is called. For this the options given are can be set off only against the short-term capital gain. Second option is can be set off against the both short-term capital gain and long-term capital gain. Third option is can be set off against any head of income, and the last option is not allowed to be set off. The long-term capital loss can be set off only against the long-term capital gain. Please remember this. And the short-term capital loss are allowed to be set off against both long-term capital gain as well as a short-term capital gain. That means if any person is incurring any short-term capital gain, short-term capital loss, then he can set off that loss against the any of the long-term capital gain or under the short-term capital gain. Okay. So the correct answer here will be option number B, that Arvind can set off against both short-term capital gain or long-term capital gain. In this question, two statements are given. The first statement is the definition of an income given under section 2 clause 24 is inclusive and not exhaustive. And statement 2 is every assessee is a person, but every person need not to be a assessee. For this, they said first option is statement 1 is correct. Option B is statement 2 is true. Option C is both the statements are true, and option D is none of the statement is true. Every assessee is a person, but every person need not to be assessee. Please remember this statement. Okay. For example, if X is an individual and he earned the total income of rupees 2.40 lakh, okay, in the previous year. So here X is the person, but he is not the assessee because his total income is less than the maximum exemption limit, that is 2.50 lakh, okay, and no tax or any other sum is due from him. If you look at the definition of an income under section 2 clause 24, it includes any sum received by the assessee from his employee as a contribution to any provident fund or any fund set up under the provision of the Employee State Insurance Act 1948 and any other fund for the welfare of such an employee. So here both the statements are true. That means the correct answer will be option number C. In this question, the assertion and the reason is given. The assertion is Budget 2020 abolished DDT on the dividend declared, distributed or paid up on or after 1st April 2020. For this, the reason given is dividend is now to be taxed in the hands of the recipient of income, that is shareholder or a unit holder. The provision relating to the abolition of DDT will be effective from the April 1st as per the amendment to the Income Tax Act. Dividend declared between the 1st April 2013 and the 31st March 2020 will be subject to the DDT under the old regime, while those declared after the 1st April 2020 will be excluded. For this, the options given are A and R are true. Second option is A and R are false. Third option is only A is true. And the last option is only R is true. The correct answer here is option number A, that is A and R are true. That means both the statement given are true. Which of the following is or are from the Double Taxation Avoidance Agreement, that is DTAA, and the options given are Tax Information Exchange Agreement. Second option is Limited Multilateral Agreement. Third option is Limited Agreements. And the last option is Comprehensive Agreements. And from this code, you have to select the correct one. Here the section 90 to 91 under the chapter 9 of the Income Tax Act 1961 deal with the double taxation relief. Double Taxation Avoidance Agreement, that is DTAA, is a treaty signed between the two or more countries and is applicable in the cases where the taxpayer residing in the one country has to earn his or her income from the another country. India has signed Double Taxation Avoidance Agreement or a DTAA with the 88 countries, out of which 85 has become effective. The correct answer here is option number D, that is 1, 2, 3 and 4. The maximum amount for deduction of entertainment allowance to government employee is. In this question, they ask you the maximum amount of a deduction of a entertainment to the government employees. For this, the options given are 5,000, second option is 7,500, third option is 1/5 of the salary, and the last option is not at all. Section 16 of Income Tax Act 1961 provide a deduction for income charitable to the tax under the head salary. It provides a deduction for the standard deduction, entertainment allowance and a professional tax. Please remember the section, that is section 16. Okay. Government employees are allowed to claim the exemption on the entertainment allowance as per the section 16 clause 2. Okay. But have a limit, that is 20% of a gross salary or a actual entertainment allowance or Indian rupees 5,000. Okay. So these are the three things which you have to remember. So here the correct answer will be option number A, that is 5,000. Deduction under section 31 clause 1 shall be allowed for those expenditure which are of a nature, and the options given are revenue, second option is capital, third option is both, and last option is none. Section 37 clause 1 says that any expenditure laid out or expended wholly or exclusively for the purpose of a business or a profession shall be allowed in computing the income chargeable under the head profit and gain of the business or a profession. So here the correct answer will be option number A. Deduction under section 31 clause 1 shall be allowed for those expenditure which are nature of the revenue.